Hi, everybody. Good to see you. Interesting times, as they say. Just before I get started, just a quick housekeeping thing, I guess I'd call it. Just a reminder, really, the family firm doesn't have any position on policy or politics. You're all paying us to navigate the situation as it is. And really, that's what we try to do. That's what we do. But, this is me. This is Nathan Gendelman speaking. And so you'll undoubtedly hear some words like idiotic, foolish, perhaps some other opinionated words. Really, those are just going to be my opinions and not, no official corporate policy. We don't have that. So where do we start? We can start with Liberation Day, April 2nd. Some of these words have probably been used by other people. I honestly haven't seen them. But I look at it as just, that day we were liberated from stability, from economic sanity, and from good judgment. And, from these couple of weeks since Liberation Day, now we've been liberated from consistency, from purpose, and from any sort of strategy. So, yeah, welcome to the liberated world. So and again, just to try to recap these past couple of weeks, which would probably take 2 hours, but what I think was originally started as a crusade to shatter globalization and really punish every foreign country, except for one, except for Russia. That's now morphed into more of a focused attack on China. Or has it? I mean, I don't know. The constant seesawing has driven consumer confidence to depths we haven't seen in many, many years. An interesting side note is I've always questioned kind of, does consumer confidence really matter? And I guess we'll find out. There has been many times in the Biden administration where consumer confidence was very low, as reported, and yet spending was fine. So in this case, we'll find out if it matters. What might be more consequential is that business confidence has also plummeted, and that's probably going to be more impactful. And as we kind of sent out in the email, I do consider it a fool's errand to really make predictions about where we're going to end up with this, except it does feel safe to say we're going to end up with some sort of level of import taxes that were above the pre-liberation era. So whether that's just 10% or name your percentage, but it's going to be something. And just trying to wrestle with, well, what are the implications of these Trump taxes, on the economy? Any imposition of taxes with no productive use for them increases the chances of recession, which are probably fairly high now. And as in most recessions, it kind of tamps down the near-term inflation prospects. The tax could be a one-time price raise, but that doesn't imply there's going to be any sort of propagation of that throughout the years. I do consider that last bit of intuition, or if you will, judgment, kind of good news, because it does imply the value of our bonds will be resilient in more of a lower inflation environment. Now, long-term inflation prospects, they're probably a little higher than they were, just because of the increased burden on businesses due to all this inefficient reshoring of, everything like growing vanilla, growing coffee, sewing garments, all these things we don't do now. So, what to think about in this kind of environment, I don't know. It seems like maybe inflation-sensitive assets, such as resources, real estate, they arguably make more sense in this environment, but it's hardly a sure thing. So that's maybe you'll accuse me of grasping for good news, but I do think the depressed inflation prospects for the near term is good news. Maybe another piece of good news, as it has turned out over these past couple of weeks, Tariff Man is indeed constrained, not by the sycophants in the cabinet, not by the presidential BFF, not by Congress, not by the pliant Supreme Court, but as we've all just seen a week ago, the markets themselves can constrain the insanity and force retreats from the most reckless tax impositions. So with the exception of the war on China's economy, nearly all of the most onerous taxes have been withdrawn or delayed, which I think we know what that means. But things have pulled back to this 10% level for the most part. And why is that? No other reason except the markets. The stock market plummeted pretty sharply there. That led to some forced selling of bonds. It pushed interest rates up. It got people scared about what was happening in the Treasury bond market. That finally got tariff man's attention, and that's why the tariffs have been eased so as quickly as they were put on. So I do consider that maybe one shard of good news for the global economy and investors, as we all just struggle to adapt to the imposition of economic policies, which were wrong-headed 90 years ago. They were wrong 50 years ago, and are even more wrong today in the globalized world that's been really built up, especially since the fall of the Berlin Wall. But really, with so many horrible things happening in the world right now, I'm just grateful for any kind of pieces of good news that we can hang on to. And again, if the market and investors collectively can impose some sort of guardrails on what's happening, I do think that's a positive. I'm very thankful to a few people that email me some questions, and I can try to address them because they might be on everyone's mind. One was just about, trying to rebalance in this environment, and what should we, how active should we be? What should we be thinking about? And I will humbly confess that it's very difficult to do. When we have the market swinging by literally thousands of points in a given day, what appears to be a good decision at 11 a.m., at 1 p.m., at 2 p.m. can appear wrong when the markets close at 4, when the mutual fund trades settle and some other things settle. So, I wouldn't describe it as that we're paralyzed, but I would just say we're being very cautious, because I don't want to get, rush in and rebalance with somebody, and then there's a tweet at 3 o'clock and we're down 2,000 points. So just trying to be a little bit careful about that, and recognizing that I'm very confident that everyone's listening to me right now came into 2025, came into April with a well-balanced portfolio, and they still have that. And there's nothing to panic about from that perspective of our portfolio balance. Someone else asked me, should we be worried about the 90-day delay? And should we be trying to get ahead of that? Because, what if we wake up in whatever 90 days is, the middle of July, and all of a sudden these incredible taxes come back on imports from all over the world? It is possible, and that would be scary. But I think in the realm of risks, that one's probably pretty low, because we've already seen that, when those extreme taxes were put on without any kind of economic sense or purpose, that the market would force a correction, and that would happen in 90 days too. So it probably doesn't make sense to go under the mattress in June or July, because chances are things are going to work out, if work out means the situation that we're in now. And of course, with most countries, there'll be some sort of agreement which will maybe on paper, and everyone will feel good, and they can get their exemption from, the worst of the worst. Another thing that I've seen, and someone asked about too, was, when the interest rates did go up there for a week or so in the 30-year market and the 10-year market, people were worried, are foreigners not lending to us anymore? Are they doing a bunch of selling of our bonds, and is that pushing the interest rates up? That doesn't seem to have happened. There's no evidence that that's happened at all. And if you are a large holder of American bonds, like the Asian central banks, like the Bank of England, many other banks, it doesn't do you any good to push down the price of the assets that you're holding. So it sounds like it's a kind of a good revenge story on their part, but there's actually no tangible evidence that it's happened. And it is kind of contrary to their own interests. So that one doesn't seem very likely. You know, the way things are. Again, if you're a central banker or just any risk-averse investor throughout the world, you really want to be sure you're going to get your money back. The United States is still considered the best place to lend to. So really that's it, because I tried not to prepare too much, because, you know, sitting here trying to think of, oh, what do I want to say? And then realizing again at 4 o'clock, it could all become moot. So I just wanted to kind of, you know, I don't want to say play things by ear, but just recognize that, oh, what happened on April 16th could change everything I was going to say. So I just would love to hear what's on everybody's mind, and if there are any big areas that I missed, or any, contrary opinions, or just anything that anyone wanted to ask or share with everyone, that would be great.
I'm just wondering if you have any thoughts about the value of the dollar and how that, how that might impact some of the investments we have.
Yeah. Well, hi, Mary. Thanks for that.
You're welcome.
You weren't anonymous on that one.
Okay.
Over these recent months, the dollar has come down, a few percent. I'm really not sure why, except the simple kind of reasoning that our economy is being driven into a recession by some crazy policies that maybe aren't being contemplated in the rest of the world. But so that's happening. But that's I guess can be a contributor to an inflationary push if the cost of the imports now go up from taxes and addition to the dollar declining. But again, it's hard to make a big case for another currency, coming up and replacing the dollar. I mean, it's fine that gold's gone up, but that's really not going to do it. And the cryptocurrencies are nonsense; they're not going to do it. So, the dollar could oscillate, or perhaps even extend its decline. But I don't know. As I'm sitting here, I really have a hard time thinking that, oh, the euro is going to become a dominant currency, replacing the dollar, or the yen, or the Chinese, yuan, which is not even an open currency. So, I do recognize that the dollar's come down a little bit. It helps our international bonds. It helps our international stocks a little bit. But I doubt that trend would really spiral out of control.
We have a question here on the meeting chat. What is the best way that we can protect ourselves or position ourselves for a recession? Any tangible steps that can be taken now?
Well, the bonds do help. And, if inflation comes down because economic activity has come down, bonds help. And we were talking about that today, and the huge financial crisis from 17 years ago, when the Treasury bonds actually did rally a lot because the Federal Reserve cut the rates to zero, bonds made a lot of money, and it did help to offset, to some extent, modest extent, the huge declines that were going in the stock market from all the ridiculously unregulated banks. But that is safe haven is too strong a word, but in a normal recession, the bonds are a good source of stability. Again, I'm very confident that the folks on the phone are not living off of their stock market holdings day by day. So it's okay. And the fact that the bonds will be stable, that gives an element in the portfolio that lets us tap for cash flow or emergency funds or something like that. And just give things time to recover, because even in kind of the dark days that it seems like we're in right now, things will recover. Policies will change, regimes will change, and the economic prosperity that's driven so much by technology really can't be stopped by a couple of idiotic policies.
Okay, we've got another message here.
Okay.
Let's see. So, would you agree that we have gone on a wild ride and we are being run by idiotic policies? But should we mostly just hang on and hold tight?
Uh, yes, I'm in full agreement with all of that. And even, I guess kind of my, I don't want to call it a thesis, but I guess we just kind of witnessed it, that the idiotic policies can get tempered by the market, because despite all of the talk on Liberation Day and a couple of days after that, oh, we don't care about investors, we don't care about the markets, we just want to bring, we want to return the world to the 1950s. Let's just put it like it is. And the stock market said, no, that's not going to work. Yeah, we're we're not gonna start sewing garments on the east side again. We're not going to do that. And we're not going to bring all the car factories back to, Detroit and wherever else, Indiana, Montana. And that prompted a change. So is it as favorable as it was, X number of years ago? Of course not. But we're just going to have to adapt to it, and the companies will have to adapt to the import taxes of 10%, perhaps higher, that don't accomplish a damn thing. And we'll just have to muddle through. But they're not, these import taxes of 10% are not going to stop Microsoft from building better software. They're not going to stop competitors to Apple from coming up, and they're not going to stop Apple itself from, maybe doing maybe by the time they get to iPhone 18 or 19, they really have some more revolutionary aspects to it. And the 10% tax or 15% tax on whatever it is, semiconductors, vanilla, coffee, whatever, it's not going to derail things permanently. So yes, I mean, just hang on, try not to look too frequently. And especially for those of us in DC, it's very hard because, obviously the economy here is bearing the brunt of all this, much of this. And, then everything runs on a very short news cycle. But really, that's the strongest advice that we give to all the clients, is try not to obsess, especially about your Schwab accounts. They're a 2,000 point decline feels really, really, really bad. And a 2,000 point advance feels, okay, that was good. The declines are what really terrifies us, really gets us at our core human emotions. And that's when we get the fight or flight reaction. And that's what we want to try to avoid as investors, because that will lead us astray. That's what's good for survival when we're, confronted with a grizzly bear, is not what we want to do when we're investing.
So we do have some follow-up questions there.
Okay.
Is there a case to make perhaps some adjustments to the portfolio, to our portfolios, and also how about purchasing gold?
Yeah. Well, hopefully the adjustments, I mean, I can't say we do everything right, because obviously we don't, but we've, been trying in these recent years with the markets at such stratospheric levels, especially with the Magnificent Seven nonsense, to try to, I will just say to underweight, but at least take a measured approach to those ultra expensive assets. And just to try to provide some cushion for when the tide turns, and, the tide has turned. So we'll see how things go going forward. But I'd like to think that for the most part, we were in a fairly good position coming into 2025, and that we weren't, we don't have anybody in cryptocurrencies, that we were taking a measured approach to the companies that require AI mania to continue, which it already is, tapering down, of course. But just to try to stay invested, because we don't know, what's going to be in favor tomorrow. Just our core philosophy as well, stay diversified, don't predict the future. But if you can avoid some of the more obvious landmines, which are things that are incredibly overvalued, you should do a little bit better over time. And when those handful of companies, should they ever become fairly valued again, or at least, reasonably valued, we'd love to invest in them. Amazon, great company, Google, great company, say, run through the list. But to pay exorbitant prices for, we'd rather not. Gold, I have to admit it's gone up quite a bit. And with the chaos that we're seeing around the world, it's, we can understand why. But it's still a risky bet for the future. It does nothing on its own, of course. It just requires other people to want to buy it. So it's not doing anything for you. And I'm not going to call it the greater fool theory because that's a little harsh. But really, the only value of gold is what someone is going to pay you for. And that's, when you're just reliant really on that kind of psychology and that kind of market, it's a much riskier, I don't even call it an investment. It's a riskier speculation than just investing in a more productive enterprise or even lending money to a government or a corporation that actually is producing something to be able to pay you back.
So we have a follow-up question. So to what extent are, the losses in the market recently, are they, due to an overpriced market and with kind of the trade policies being a catalyst for them being sold off?
Yeah, well, I mean, I think that's a fair description of what's happened. So certainly the most yeah, again, I'm going to say this because I said it before. I said it at Foresight too, but the most overpriced stocks have been the ones that have borne the brunt. But really, it's been all over because a lot of the obvious names. Okay, so they've fallen due to a little bit of the waning of the AI mania, in addition to some more competition. But also the small companies are getting hammered by the tariffs. These small companies, I mean, they import things. They're importing them from China or from other parts of Asia. And I mean, it's obviously not going to stay at 140%, but it's going to be something bad. And small companies are really bearing the brunt of this. And I forget if there was a second part of the question, Steve.
Nope, but
Oh,
you have
okay.
it. Yep.
Yeah. So partly the trade and partly just some of the helium coming out from the mania.
Hi, I was wondering about something you said earlier about bonds and how we are protected by our bonds in the portfolios. I was wondering what percentage of my portfolio should be bonds if I'm like 5 or 6 years away from retirement. Thanks.
Yeah, well, I don't want to, not necessarily throw off anything casually, because of course what we really do is want to do a deep dive into everyone's situation and make sure their cash flow is in line with their investments. I would say really just off the top of our head, which don't invest based on this, but someone who is in the 5 to 6 years from retirement, maybe they'd want to have a third in bonds, maybe a tiny bit more. Of course, it depends on an individual's own risk tolerance, and that what sort of decline would prompt the fight or flight emotion, which we really want. That's the one thing we never want any of our clients to feel. So we try to get to really know everybody really well, and to just come up with a recommendation that they can live with, and that'll be good. That can get them through not just to retirement, of course, but the 30 years following that.
Dave, if I can, this is Gene Meyer. You haven't impact on inflation. How much are prices for the average family going to go up? It's been estimated $2,400 a year, $4,000 a year from these tariffs. What do you think?
Yeah, I mean, no one can really be sure because, of course, it depends what you buy, right? So one thing that Tariff Man is accomplishing as he, drives us into a recession is that the price of energy seems like it's poised to come down quite a bit. The price of oil itself has come down. And of course, as we were saying in a meeting today, that it eventually filters down to what we pay Exxon at the pump. But that is going to happen. So that will be one bit of relief for inflation. And, whether we like it or not in this world, a lot of things that could come into our basket of things we buy end up being connected with the cost of energy. So it's quite possible, some of those projections were made thinking, oh, well, oil's, $80 a barrel. And so that, plays out from there. And now it's 60. And if, we really do enter a more severe recession, or even a recession that's a little bit more than it's being anticipated, then, energy prices and a bunch of other prices would fall from there. And that would, it would mean that we're not going to have this, maybe the dire situation that it seemed like we were facing a couple of weeks ago. I guess we'll all find out, or I hope we're not going to find out, but if we just increase the price of an iPhone to $2,000, how many people are going to buy them? Like, is that really inflation doubling, or is it just the fact that so many people will not be able to buy one or not want to buy one, that the prices will have to come down? And that's the fancy word for that from an economic viewpoint. It's a recession. That's what a recession is. We buy less phones. And so that's why we can't just increase the price of something and say, oh, that's it, we've created inflation, or we've accomplished something. It's just not, it's much more complicated than that.
Yep.
I took out my entire RMD in January, and I felt like I was being a little I wasn't being that smart, but in retrospect, it looked like a pretty good idea. And if we're looking at the market as on a downward slope, it seems to me that it makes more sense to pull cash flow out now as opposed to let the market decrease the overall value. What do you think?
Oh yeah, I wish we knew if it was going to go up or down. Right, that's the point. Is that, well, it depends what you do with the RMD. But if you just put it into a checking account, you'll have a 0% expected return. So I don't know what's going to happen, but I do know the expected return of remaining invested in a diversified account, like you were, makes more sense than replacing it with a expected value of 0. So, no one really knows what's going to happen the rest of the year. We're down a handful of percent this year, 6%, something like that, from the stock market side. So, could it go down from here? Of course, but it's just as likely that it could go up.
I'm reacting to the doom and gloom. The conversation in general about the markets doesn't seem like they're going to climb, but you're saying that no one can tell.
No one can tell. And actually, I'm not sure if I know we're not, but when people become pessimistic, and I'm not, I don't think we're there yet, because I've had these shards of optimism. So, but it's really at the point where everyone has given up, and it seems like there's no optimism at all. It turns out that that's the best time to buy. So, are people a lot less optimistic now than they were after the election, when we heard a lot of nonsense? For sure they are. And, things are cheaper than they were then. Maybe justifiably so, but they are cheaper than they were then. So, I don't know what's going to happen tomorrow, but again, in hindsight, are we at a better time to buy now than we were on election night? We are.
So what are your thoughts on, conserving cash versus, completing a planned home improvement, for example? Is now a bad time to do something like that?
Well, it's always good to have some perspective, right? So we're just coming off of 2 ridiculously good years in the market. So 23 and 24, bouncing against record highs, many, many record highs over these couple of years. And yes, things have retreated a little bit, as we've talked about. You know, a single digit retreat from the highs, maybe 10% after today. I don't know. But still, things are okay. You know, it's not, this is, if we need money, we can sell stocks and not feel like, oh, we were selling, you know, on after Black Monday and, you know, we've just locked in these huge declines. So, you know, you planned home improvements. We know we've got to finance them, have the resources for them. You know, would it be a little better if things were at their absolute peak? Of course it would. But are we talking about a real bear market, a low point in the market where it seems like there's doom and gloom everywhere? You know, absolutely not. So I think, you know, if people need to, for whatever reason, trim down their portfolios to finance something important, you know, it's okay.
All right. Well, for any of your friends that have missed the call tonight, we will be sending out the recording. Feel free to send it on to them, or if you want to rewatch and listen, it'll be available to you as well. Thanks so much for joining. We appreciate you tuning in.